Welcome. We're going to talk today about qualifying the buyer. So I've upgraded our speaker today from Bill Gaylord to Garrett Tyler. Garrett and I have known each other for years. He's been with the Gaylord Hanson team for years, runs the sales side of things. And so today we're going to talk about just the basics. And we've touched on some of this with the stuff for Bill, but I just want to walk through as he's a loan officer, what's he looking for? So if I was to come to him and say, hey, my agent said I need to get pre-qualified, what do I do next? And so, what do I do next?
Absolutely. Thank you, Kevin. Well, hi, everybody. First steps really are just kind of understanding your financial snapshot, right? And what is a financial snapshot to somebody like us? Whenever you're getting pre-qualified or pre-approved for a mortgage, we're looking at three things, and three things determine your qualification. And so we call them the three pillars of the mortgage industry. That's your income, that's your asset, and that's your credit. Once we've verified those three pieces of information or those three qualifying tools, then we're able to tell you, based on this information, here's where your financial snapshot is. This is what you would be able to be pre-approved for or go purchase out in the marketplace based on the amount of assets you have to contribute to a down payment. Based on the FICO score that you receive will determine kind of the qualifying rate and loan program you'll get. And the amount of monthly income you make, right, is going to determine how much you're able to afford in that type of home. So really the first steps are to get in touch with a real estate agent and a lender and an expert so that they can review your financial snapshot for you. You go through that loan application process, and then they verify your income, your assets, and your credit to determine that. And that doesn't need to take, a week. That can be all happening within an hour or 2 hours, even sometimes faster if you're really, up and ready with your information.
So let's talk about it. Let's go a little deeper on each parts of this. Obviously, the credit part kind of takes care of itself. Borrower authorizes you to run credit. A few keystrokes later, how long does it take to get a credit report?
Yeah, absolutely. The credit report, as soon as you press yes to letting the lender run credit, it'll run it automatically through our system. It'll come right to the loan officer, and they're able to verify your type of credit report within 15 minutes of you completing that application. And the application typically only takes you about 15 minutes, like Kevin was mentioning. You'll go through a couple keystrokes on the computer, where you're currently living, where's your employment at, how long have you been with that employer, other personal identification information so that we can see the credit, the income, and the assets. About 15 minutes to 20 minutes it should take you to do that online application. And then, if you've given it and authorized that credit pull through the application, it comes directly to us with that credit report in hand ready.
So that's a really key element, because that's going to launch, as we've talked about, and I went over, Garrett shared, and I recorded. You're going to forget which week I've covered it, but I kind of went over the pricing based off of tiers of credit. So let's talk about those tiers of credit just for a moment.
Yep.
When is it like wow, you walk on water, and when is it I hate to tell you this, but you ain't buying a house?
Typically, great question. Anything above, let's just talk normal conforming, which is just the basic traditional loan out there.
I call it plain vanilla loan.
Exactly, your vanilla loan. 740 FICO score and above is going to be the top tier of credit on there. And then it moves in a tier by 20 points each time. So if 740 to 720 will be a certain tier. So if you have a 730 FICO score, it'll be a bit less of a better interest rate than if you had 740 or above. Then the next tier, right, is going to be 720 to 700, then 700 to 680, 680 to 660, 660 to 640, and then the last on the conforming loan is going to be 620 to 640. Past 620, conforming doesn't let you get a loan at all anymore. So if you're, and that's because most investors or banks don't allow for the loan program to go past 620 in FICO score. So other loan programs are out there. FHA, VA typically will let you go down to about as low as 580. Now the FHA and the VA do not have a FICO score requirement, but the lenders, the investors, the bank themselves, they do. They have what's called an overlay on that guideline. So you can get into a property about 580 or higher on a certain type of loan program like the FHA or VA. Once you get to 620, you can typically be on conforming. But like you mentioned, when are you walking on water? It's typically above 740 or higher. And when can you typically not get a home, or when is it not maybe the best decision for you to get a home, is below that 620 mark, because there's a bunch of what we call loan level pricing adjustments that make that interest rate unfortunately worse, because that mitigates the risk that the lender has because of the lower FICO score. So,
lower FICO score is a double whammy.
Yeah.
It's going to be harder to get a loan, and you'll pay more for it, either in the cost of the loan or the ongoing cost of the loan in interest.
Yep.
Not to go too far down the bunny trail on this, let's say I'm at 735, and I really want that better pricing, and I've got time. What are some things that you could do for me that can help get my legally, ethically, etc., get my score maybe up 5 points or 15 points or something like that?
Great question. There's a couple of tools. So there's what we like to run. A lot of direct lenders like ourselves, we have credit simulators, meaning we can verify based on your credit report. We can plug in if the balance on this credit report were to have gone from, let's say you have a 4,000 credit card balance and you have a $10,000 limit on it. If we can show the system that maybe you've paid off that balance by 2,000 and you've dropped that balance now to 2,000 over a credit limit of 10. We can run a simulator to see if that would be able to improve your score by 5 points or 10 points, whatever it would take to maybe possibly get you to that next tier. So there's cool simulator tools that allow us to kind of tinker with, hey, if you've paid off this much on this type of loan installment, or if you've paid off this much on a credit card, how will that affect your FICO score? Other ways, we just know basic rules. If you can keep your credit utilization factor at 25% or lower, that is going to be the section where you are generating the best FICO score for the algorithm with FICO. And what credit utilization is, real quick, I'll do that very fast for you, is let's say your balance right on your credit card is $10,000. I'm sorry, let's say your credit limit is $10,000. Let's say your balance is $5,000. Well, then you have a 50% utilization factor. If you get that balance to about $2,500 or lower, then that's when you're going to start seeing the best algorithm produce a good FICO score for you.
Yeah, so it's a little bit of black magic, but it's mostly understandable, and it's nothing. You don't have to do crazy things, but you got to be smart. Yes. And I'll just put this one other caution out. Just like it's not always good to be your own doctor or your own attorney, try not to be your own loan officer and go, oh, I know what I'll do, and you run out and do something. I'm going to cancel all these old credit cards I've got. Well, no, that's going to work against you. Talk to the professional. Let him or her tell you, let me guide you through this process. It's not their first rodeo. They've done it before, and they will guide you through the process to get the result that you want. Okay, that's credit. Let's talk a little bit about income.
Yep, income. So credit, right, is a big pillar. Income is probably the second biggest pillar. I'd say always credit's going to be your number one.
It's kind of a give or go at that point, right?
Exactly, because that's going to tell you, hey, you can get a good type of loan program, a decent one, or you need to get your credit better before we go out and go shopping with you. But income is going to be the driver of how much you can afford, right? So income is going to tell us, hey, have you consistently been making the same type of income for about a 2-year period of time is what most lenders like to check. Some loan programs let you go back as just 6 months of work history and verifying that. But typically your income, your monthly income is just going to determine how much you can afford per month and your new housing payment that we would project on giving you with buying this new property, plus all your other liabilities or all your other debts, and we come up with what's called a debt to income ratio. So your debt divided by your income will give us your debt to income ratio, and we typically got to keep that below 49% on most all loan programs, and we can be in a qualifiable spot.
So just pick up your book for a moment. When you get in the book, they're still talking 28 and 36%. 28 front end, 36 back end, and that's why I bring you Garrett to have real life to go. Right now, real life, you can go higher, but just know that sometimes when you go into that stratosphere, that you got to have everything lined up right. They're not going to step out and make a stupid loan, as they did
in 2008,
in 2007, and 2008, right? So in the book for the test, it'll be 28, 36. Real life, it's much higher, and each loan program is different. And we'll talk about VA and FHA on another video, and we'll talk about those debt to income ratios also. Let's talk quickly about income as far as like you and I.
Yeah.
We're salespeople, right? I mean, so we make our base salary, and then sometimes we make bonus, commissions, and things like that. How do you justify that, or how do you compare that to someone someone works at Qualcomm and they make $150,000 a year? We just know how much that's what they made last year, and that's gonna
Yep, 100%. So big history. History is going to be the indicator of what we can use on all of the what we call variable types of income. So bonus is variable, overtime is variable,
okay.
And what we would structure with on that is a 2-year history or a look back with all your employers. You can transfer employers and still be able to use bonus. We just have to be able to show that you've received bonus in the past, or that you've received overtime or some type of variable income in the past. And that look back period is about 2 years. So if you've earned bonus, you've earned commission, or you've earned overtime over a course of 2 years, we'll absolutely be able to use that type of income, on an average moving forward, and help that qualifying rate. If you have a base salary, you absolutely get to use that base salary right out the gate. So that's what we know about those Qualcomm employees, or those very strict W-2 employees. It's awesome because you set in stone know exactly what they're going to receive per month. If you're a commission-based employee, right, we do have to take an average based off of what you've produced over a period of time.
And sometimes with commission-based people, you have to look a little deeper. Like a real estate commission person, you're going to look at their taxes to see what they're writing off.
Absolutely. A real estate agent, for example, yes, you would have to confirm that they've been having listings, or they have had buys the exact same amount in previous, if we're trying to qualify them for a certain type of income. So if, let's say, we're trying to qualify for $10,000 per month in income, well, we need to see $10,000 per month of income for the last 12 months, or the underwriter's not going to allow for us to say, we can confidently say, that sales agent's going to be able to bring in $10,000 next month.
Right.
If you've done that for 12 months or more, we typically are able to get that approved.
Right. And by income at that point, we're also saying if you're writing off your car, and if you're writing off your health, and you're writing off your dry cleaning and all those things you can.
Your big marketing budget you have potentially.
Yeah. All the marketing budget, and then so you've smooshed this down to where you're only showing $4,000 a month in income. He's only going to use $4,000 a month.
Correct. We can only use what you show to the IRS. So know that. So we love to call that very taxed advantage. So if you're very taxed advantage with your CPA, you're probably not going to show nearly as much income, and we won't be able to use all that you've actually received. What we do need you to do is file your tax return exactly to what you've earned, because then we can use what you've shown the IRS, and that is all that a lender can do on a traditional mortgage.
Yeah, and that's a big part of that tighten up that came with Dodd-Frank and the 2008 debacle and all that. It's like, no, we don't get to make that stuff up anymore. And the process for them to be able to get a copy of your IRS report is so much easier now.
Absolutely.
Where it used to be weeks and weeks we had to send something in and wait for it. Now it's almost instant.
Yeah, too many people maybe won't like this, but the IRS and banks are like this now. They've streamlined a communication of transferring information and documentation specifically for self-employed people. Just like Kevin was mentioning, if you're writing off all of your income, we're not going to be able to use anything because you've shown the IRS you made zero in income. So it's very important if you're a self-employed borrower, to not write off nearly as much if you're trying to show more income to qualify.
Yeah. So there's a price to pay. You're either going to pay the taxes or you're not going to get the house.
Correct.
So, okay, third pillar.
Third pillar, assets, man. So this one, it's important, but it's not nearly as important as the other two. But these are the three pillars, so they are just as equally important. But this one kind of just determines what type of loan program you're going to get into. So more of the assets, or more of your own investment that you bring to the down payment, which is your own money, then typically the better the mortgage you're going to receive, or the better opportunity for a better mortgage loan, because that's seen as less risk, right? You're bringing in personal money, you're bringing in your own investment. The bank's going to go, well, hey, we like that. Thank you for doing that.
You got more skin in the game.
You got more skin in the game. I don't have to make this, this large of a loan for you. We're going to give you a better interest rate potentially. So typically, down payment or assets are in 5% tiers. So just like we were talking about FICO scores moving in 20-point tiers, assets move in 5% tiers. So you typically receive a better mortgage or a better interest rate every time you bring in about another 5%. So there are 0% down loans across the entire board. Doesn't just mean VA loans anymore or 0%. There is a conforming loan with 0%. Now, it's very tough in this market to qualify for that type of loan because you have to meet a perfect sandbox, but there's a bunch of options. If you go to 5%, there's a better loan program, conforming loan. You go to 10% down, there's a better rate and loan program that you'll get from there. You go to 15 better, 20 better, 25 better, and typically right when you get to about 40%, all investors or all banks kind of stop that limit there, and you receive the same mortgage at about 40% down as you would receive putting, 100% down, or not 100 because you wouldn't have a loan.
Right.
That's you having cash, so good for you. But no, if you put about 90% down, let's say, it'd be the same as you getting a 40% down loan as well.
Okay, so these assets come in lots of shapes and sizes. What can we count and what can't we count?
Yeah, typical, let's go back to that vanilla loan, right? A conforming loan. That's the average loan that's sold everywhere across the nation. Well, that's going to be any asset that you have collected and saved over a period of time of at least 60 days. So if you've verified, invested that money in your bank account for 60 days, well, then with the bank, then we can typically use that type of asset. So for example, if you have checking and savings, that's the number one that we typically see. That can be used for down payment and closing costs on a home. If you have an IRA and you're a first-time home buyer, you can absolutely borrow from that with zero penalty and use that. If you're just really tight on maybe those closing costs, you can utilize a portion of your IRA or your employer 401k. We typically want to only let first-time home buyers use that because they can borrow that money. They don't have to do an actual withdrawal and pay a penalty. If you're not a first-time home buyer, you'd have to do a withdrawal from that account, and then you're paying taxes and you're paying penalties, and that typically doesn't make sense to do. So we avoid those two types of accounts. But any other type of brokerage account, money market account, stocks, bonds, we've even closed a jumbo loan with cryptocurrency here at our office. So Now cryptocurrency took a little bit of history, right? We had to show that the borrower bought the crypto 3 years ago with their own funds, how it got transferred through the blockchain into their checking and savings account. That was probably the deepest dive of assets I've ever done. And I wasn't even my loan. It was Jeff Olson on my team, who phenomenal loan officer, but we had to verify so much of that borrower's assets and how he purchased that crypto to show that it was legit. But we were able to use it because we were able to verify it back to 3 years how he purchased that cryptocurrency. So any type of investment that you have in a brokerage account or money market, we typically will be able to use. We just have to be able to see the source of how it got there.
Okay. If it's been less than 60 days. If it's been 60 days or more, do you care?
Verify? No. Crypto, yes.
Crypto, yes.
Crypto, yes. Anything else, no. If you get,
if he cashed out the crypto, put it in his checking account 90 days ago, you wouldn't have known.
Wouldn't have even known because we wouldn't have gone back and asked.
And this is something that comes up sometimes. And again, talk to your loan officer first. Let's say mom and dad are going to give you money for a down payment. Okay, there's a couple avenues we can take with that. So you cover it.
Yeah. So if mom and dad are going to give you money to help with down payment, that's awesome because typically we'll want to label that as gift funds, meaning you're not expected or not planning to pay back mom and dad for those funds that you've been given. And then we don't have to qualify you with a monthly payment. If mom and dad expect a repayment on that, then we unfortunately can't label those gift funds, and we have to set up a promissory note and create a plan so that you're paying back that person, your parents, and then we qualify you with that payment. So that hurts your debt to income ratio. typically parents right now are giving the money as gift funds, and they're doing whatever they want outside of escrow or outside of the close of the transaction. So if we're able to verify that, hey, there's no prepayment, there's no penalty or payment back to the parents, these are gift funds, well then we can absolutely use those gift funds on a conforming government or jumbo loan even. If mom and dad want to give you 20% for the down payment, you can absolutely use that and bring in 0% of your own invested money. What Kevin was bringing up was good to know is don't just get that money from mom and dad right now and think that you want to put it into your checking or savings account, because we'll have to verify a couple things depending upon how fast we move in the transaction. If we are ready to rock and roll and move right away and you've already deposited those monies from mom and dad in about a week ago, well then unfortunately we're going to be asking for your bank statements and mom and dad's bank statements, because that's the Patriot Act. So just like we were talking about the tightening from 2006, 7, and 8 because of the crash that we had caused by the housing market, well, we're underwriting loans very strictly now, and a part of that is the Patriot Act, right? That was created from, unfortunately, 9/11.
Yeah.
And we have to verify all types of money laundering. So if you receive money shorter than a 60-day window, we have to verify the full source. So if you did it with mom and dad and you've already deposited it, we got to go get mom and dad's bank statements too. And if, let's say, they transferred that money from one of their other accounts, we'd have to go to that account and figure out where they got that money. So the easiest part of the transaction is you can kind of avoid that Patriot Act or avoid that process, because it's allowable if you keep that money in mom and dad's bank account and you keep your own investment in your bank account. At the end of the escrow period, or very close to, about a week before closing, we would just have mom and dad wire in money directly from their checking account into the same escrow account that you're wiring your money into for the purchase of the home. So like you said, right now, don't think that you have to be that expert for yourself, just like you wouldn't be the expert on your home. You'd call Kevin to tell you, is this the right type of home I should be buying? Is that a problem with this, piping, and is this plumbing? You're not gonna know that. He'll know that. Same with us. We'll know what type of assets we can use. We'll know exactly when you should transfer that money, if you should even transfer it at all. So yeah, just call us and let us be the experts for you. That's what we're here for.
Yeah, absolutely. Okay, so that's the 3 pillars to qualifying people.
Yep.
So you get all this information, you and your team, they've got like behind us here, for just miles behind us here, all these processors and process. Now it's very streamlined in that everything happens on computers anymore, and I know from talking to Sam years ago, it's like piece of paper comes in, it gets scanned, and the thing gets shredded. There's no pieces of paper anywhere. I can't say the same about our office right now. But so you're doing part of the work. Your processor's doing a lot of the work. It gets all bundled up in your system, and then it gets pushed over to the underwriter, right?
Correct. Pretty much. So we would we collect all your income, all your assets, all your credit, and we collect the documentation to verify that. So
it's all verified.
It's all verified. We got your W-2s, your pay stubs. We put it together. Let's say now, you and Kevin went out shopping, found a property that you absolutely loved. You made an offer, and yay, you got the offer accepted. Well, then it's our job right at that moment to now take your qualification, bundle it up with the property, and say, okay, here underwriter, or here conformer of our bank, right, that says, I will give you the stamp after reviewing this documentation, you are approved. And if you get that stamp from an underwriter, that's the bank's way of stating, we will absolutely guarantee that we will get you this loan if you can get us these conditions. And so that's called a conditional loan approval. So the moment you get an offer accepted on a property, after we've already verified that you're pre-approved for it, we take all that documentation, we give it to the underwriter who can give us the stamp of approval, and that stamp of approval will come back with a conditional list saying, hey, based on this documentation that you can also provide me, if you can get it to us, we can absolutely give you loan approval and close this loan.
And we usually call those housekeeping items, like I need your most recent bank statement. I've got 2 months here, but there should be another one coming out. I want to see a copy of that. Give me a letter explaining what this thing on this credit report, what was that, you know? And it's just simply the borrower says, oh, well, I bought a XYZ for the office, and that, you see over here I got reimbursed So they're just looking for anomalies. They want to make sure to have everything buttoned up.
Yep, absolutely. You got bonus in January for 200. You got bonus in February for 500, and then back to March you got bonus for 200. The underwriter is going to come to us and say, well, why was their bonus a little bit larger in February? Are they going to see bonus like that in the future? Because the underwriter is going to also want to see if they can increase that income for you to give you a better ratio or a better debt to income ratio.
And they're also kind of looking for compensating factors like, I can let them slide here because I have these other positives over there.
Yep.
She only makes this much now, but next year she's going to quit being a teacher's aide and be a teacher. So we can't spend that money yet, but it's a compensating factor. We've got positive things happening. So.
Yes.
Well, outstanding. So that wraps up. So the topic is, how do we qualify the borrower? And I think we've kind of covered top to bottom. Thank you so much, and we'll be back with how to qualify the